It started with a crash. October 29th, 1929. Black Tuesday, when millions of Americans watched their wealth evaporate in real time, and as panic gripped Wall Street, one man sat down not to escape the chaos, but to understand it. Benjamin Graham, a young investor who would go on to write the most influential book on investing ever published, The Intelligent Investor. A book Warren Buffett calls by far the best book on investing ever written. And this story, like so many others, is not about genius or luck. It's about principles, patience, and discipline. Three things anyone, including you, can master, no matter your income, age, or background. In this video, we'll walk through the timeless wisdom of Graham's masterpiece, not as a textbook, but as a guide to becoming what he called a truly intelligent investor. And we'll do it through story, reflection, and step-by-step insight. First, let's understand what Graham meant by intelligent. It had nothing to do with IQ. Graham believed intelligence in investing is about temperament, not brilliance, and that the real enemy of wealth isn't ignorance, but emotion. Fear, greed, and overconfidence destroy more portfolios than bad stock picks ever could. So the intelligent investor learns how to master their behavior and use a strategy that works in all markets. One of Graham's most enduring lessons is this: investing is most intelligent when it is most businesslike. In other words, don't treat the stock market like a casino. Treat it like a business partner. That partner is Mr. Market, a character Graham invented to explain market behavior. Mr. Market shows up every day offering to buy or sell you shares, sometimes at wildly optimistic prices, sometimes at irrationally low ones. But here's the secret. You don't have to accept his offers. Your job is to evaluate, not react. If Mr. Market is manic, let him be. You make decisions based on value, not mood. And that leads to Graham's core concept, value investing. At its heart, value investing is about buying stocks for less than they're worth, investing with a margin of safety. It's no different than buying a house worth $300,000 for $200,000. The lower the price, the greater your cushion if something goes wrong. But here's where it gets real. Graham wasn't promising quick wins. He warned against chasing trends or timing the market. Instead, he preached long-term, disciplined investing based on facts, not feelings. That means reading financial statements, understanding the companies you invest in, and being skeptical of hype. And this is where Buffett took Graham's ideas and ran with them. Buffett added the idea of quality to the idea of value, saying it's better to buy a great company at a fair price than a fair company at a great price. But both Graham and Buffett agree. You must treat investing as ownership, not speculation. That means asking, would I still want to own this company if the stock market closed for 10 years? If the answer is no, you're not investing, you're gambling. Graham also introduced two key types of investors: the defensive investor and the enterprising investor. The defensive investor wants simplicity, peace of mind, and solid returns with minimal effort. And for them, Graham recommends a diversified portfolio of low-cost index funds or blue-chip stocks and bonds. The 50-50 rule, adjusted by age and risk tolerance. For example, if you're 30, you might have 70% in stocks and 30% in bonds. If you're 60, maybe 40-60. The point is balance, not chasing returns. The enterprising investor, on the other hand, wants to beat the market and is willing to do the work. This means deeper research, analyzing balance sheets, understanding earnings, and being ready to hold, not flip, a stock when you find value. But even for enterprising investors, Graham had warnings. Beware speculation disguised as investing. Be wary of hot tips, market predictions, and fast gains. Stick to your discipline, or the market will punish you. One of the most powerful ideas in The Intelligent Investor is that of emotional control. Graham said, The investor's chief problem, and even his worst enemy, is likely to be himself. That's why intelligent investing is more about character than credentials. It's about being steady when others panic, calm when others are greedy, and humble when you're right. Let's take an example: the dot-com crash. In the late 1990s, tech stocks soared. Many had no profits, no revenue, just hype. Investors threw discipline out the window. But Graham's students, value investors, stayed cautious. When the bubble burst, they had the cash and courage to buy quality companies at bargain prices. The same happened in 2008, and again in 2020. That's the power of long-term thinking. Graham also emphasized the importance of a margin of safety. This is the difference between what you pay and what something is truly worth. Think of it like crossing a bridge. If the bridge can carry 10 tons and your truck weighs 9.9, you're cutting it close. But if your truck weighs 5 tons, you're safe. In investing, you want that margin. Never assume everything will go right. Build a cushion. This principle alone can save you from disaster, and it's not just about stocks. You can apply Graham's ideas to real estate, business, even personal decisions, like not stretching your budget to buy a home or building an emergency fund. Because safety isn't about fear, it's about staying in the game. Graham also had strong views on market forecasting. He didn't believe in it. He knew no one could predict short-term moves. Instead, he advised setting expectations around long-term averages. Historically, the market returns about 7 to 9% annually over decades. Don't try to beat the market every year. Aim to participate in it patiently. And that patience is what separates investors from speculators. Speculators want excitement. Investors want results. Speculators ask, what will go up next? Investors ask, what's worth owning for the next 10 years? And it's not just about returns, it's about risk. Graham believed managing risk was more important than chasing gains. That means diversification, not putting all your eggs in one basket, and being okay with boring investments that quietly compound over time. Think of it like farming. You don't dig up the seeds every day to check progress. You plant, water, and wait. The intelligent investor plays the long game and understands that volatility is not the same as loss. Markets go up and down, but if you own quality at the right price, time is your ally. Graham also believed in regular review and reflection. Set a schedule to look at your portfolio, quarterly or biannually, and ask, has anything fundamentally changed? Is the company still strong? Are my goals the same? Don't react to headlines. React to facts. And always, always remember, investing isn't about perfection. It's about progress. Small, consistent, informed steps build wealth. You don't need to beat Wall Street. You just need to outlast it. So let's summarize the core pillars of the intelligent investor. First, invest with a business-like mindset. You are an owner, not a trader. Second, control your emotions. Fear and greed will derail you. Third, seek value. Buy with a margin of safety. Fourth, know your investor type, defensive or enterprising, and build your strategy accordingly. Fifth, avoid speculation. Stick to what you understand. Sixth, diversify and protect against risk. Seventh, think long-term. Wealth takes time. And eighth, review regularly. Adjust with intention, not emotion. These aren't just rules, they're guardrails. They keep you from falling off cliffs when the market shakes. They guide you back when hype distracts you. And they work, decade after decade. Because while markets change, human behavior doesn't. And that's why Graham's work is still relevant today, 70 years after he wrote it. His wisdom lives on through Buffett, through thousands of investors, and now, through you. Because the moment you stop treating investing like a game and start treating it like a disciplined path to freedom, You've become what Graham hoped every reader would become, an intelligent investor. So if this video helped you see investing with fresh eyes, subscribe to Read to Think for weekly breakdowns from the world's best financial books. Leave a comment below. What principle from Graham's strategy will you apply to your own investing? And remember, true wealth isn't loud. It's thoughtful, patient, and built on principles that last.